Welcome back to Talk Tickers. Today we're doing a deep dive into a really interesting one, SmartRent, ticker SMRT, their Q2 2025 earnings call.
Yeah, interesting is definitely the word. This is a hardware-enabled SaaS company playing in that multifamily real estate space.
And the call, which happened mid-session August 6th after results dropped before the market open, presented, well, a bit of a paradox, didn't it?
It really did. You had these headline numbers that frankly looked pretty rough, but then you listen to the management, the new CEO Frank Martell, and they're telling a story of aggressive strategic change.
Okay, let's hit those rough headlines first, because that's what the market reacted to initially. Total revenue came in at $38.3 million. That missed the consensus estimate of around $41.1 million.
And not just missed, but down 21% year over year. That's a big drop.
Yeah, a big drop. And it wasn't just revenue. GAAP EPS also missed, a loss of 0.06 cents versus the expected loss of 0.04 cents.
Adjusted EBITDA didn't look good either. A loss of $7.3 million this quarter compared to actually being positive, $7.9 million a year ago.
Oof. And even gross margin took a hit, down about 260 basis points year over year to 33.1%. So you see numbers like that, 21% revenue decline. The first instinct is worry.
Absolutely. It looks like things are going the wrong direction if you just stop there. But, underneath that surface, there were some positive things management really wanted to highlight.
Right, the underlying stuff like annual recurring revenue, ARR, that actually grew.
It did. ARR hit $56.9 million. That's up 11% year over year. And that's the sticky revenue, the predictable stuff.
And the SaaS-specific revenue, the software piece.
Also up, reached $14.2 million. Critically, that's now 37% of their total revenue. So the mix is shifting towards that higher quality sauce.
Okay, so the story management is pushing is yes, total revenue is down, but the good revenue, the recurring SaaS revenue is growing and becoming a bigger piece of the pie.
Exactly. And they've got the financial muscle to handle this kind of transition, which is crucial. They ended the quarter with $105 million in cash.
Plus that undrawn credit line, right?
Yeah, another $75 million available there. So they have a pretty solid liquidity position to kind of weather this strategic shift.
So let's talk about that shift. New CEO Frank Martell, what's the mandate here? What's he trying to fix?
Well, he's leveraging their scale. I mean, they have a huge footprint, 850,000 deployed units, something like 3 million connected devices out there. The focus now is purely on operational rigor, getting disciplined, accelerating the path to profitability.
And part of that discipline meant stopping something they were doing. That explains the big revenue drop.
Pretty much. They made a very conscious decision, they said, to move away from these one-time bulk hardware deals.
So selling lots of locks and hubs and big batches, maybe without guaranteed installation or long-term contracts attached?
Kind of like that, yeah. Deals that boosted the top line in the short term, but maybe weren't well aligned with when customers would actually implement the software side, the SaaS piece. It created lumpiness and maybe wasn't the most profitable business.
So intentionally shrinking the less desirable part of the business. That hardware revenue plunging 39% year over year makes more sense in that context. Still a shock, though.
It is a shock to the system, definitely. But they're pointing to the margins. That SaaS gross profit margin is still strong, around 70%.
70%. Okay, that's a healthy software margin.
Right. So the argument is, let's sacrifice some low-margin, unpredictable hardware revenue now to build a business based predominantly on that 70% gross margin SaaS recurring revenue later. It's a trade-off. Painful now, potentially much better long-term.
But making that trade-off work means you have to get costs under control fast, especially if revenue is intentionally taking a hit.
And they're being really aggressive there. They expanded their cost reduction program. The new target is $30 million in annualized savings.
$30 million, that's substantial for a company this size. Where are those savings coming from?
Mostly already executed, they said. Primarily staffing reductions, unfortunately, but also optimizing how they work and cutting back significantly on third-party spending.
Okay, $30 million is a big number. The risk, I guess, is cutting too deep, right? Especially if you need your sales team firing on all cylinders to sell that higher value SaaS.
That's the balancing act, absolutely. Management's position is that these cuts were targeted, focusing on efficiency, getting rid of redundancies, not kneecapping the core growth engine.
And the ultimate goal of these cuts, combined with the strategy shift,
is to achieve adjusted EBITDA and cash flow neutrality. Not full year of profitability yet, but getting to a neutral run rate as they exit 2025. That $30 million savings target is the key lever to pull to get there.
Plus, they mentioned getting cash from working capital?
Yeah, they expect to generate about $15 million just from managing inventory and receivables better. So that helps protect the $105 million cash pile while they execute this plan.
Okay, strategy makes sense on paper. Liquidity is there, costs are being cut. But is it actually working? What are the operational metrics telling us? Units deployed.
The installed base looks healthy. Units deployed grew 10% year over year, up to 848,000.
Yeah.
And churn, people leaving the platform, is incredibly low, like less than 0.1%. So customers who are on board are staying.
That's good stickiness. What about new business? Are they still signing deals amidst this pullback?
That was actually a bright spot. New units booked hit over 24,000 in Q2. That was their best quarterly booking performance in over a year.
Okay, that is interesting. So even while they're being more selective about which deals they take, pulling back from pure hardware plays, the sales team is still finding traction with new unit commitments.
It suggests the rebuilt sales organization might be hitting its stride, focusing on the right kind of deals now.
And this ties into average revenue per unit, ARPU, right? Because not all revenue is created equal here.
Exactly. The overall existing SaaS ARPU is kind of flat year over year, around $5.66 per unit per month. But here's the kicker.
Go on.
The SaaS ARPU on the new units they just booked, significantly higher, over $8 per unit per month.
Wow, okay. So nearly a $2.50 jump per unit per month on new deals compared to the average of the installed base.
Right. That's huge. It shows they're successfully selling more value, maybe bundling more features, or just having better pricing discipline on new contracts. They're landing better quality deals from the start.
That's probably the single most important data point supporting this whole strategic shift, isn't it? Proves the pivot towards higher value recurring revenue is actually possible.
I think so. If they can keep booking at that $8 plus level and eventually migrate even part of their huge existing base upwards,
Yeah.
the financial leverage is massive down the line.
And this idea of adding more value, moving beyond just, say, smart locks, that's where AI comes in. They mentioned that quite a bit.
They did. Talked about the progressive infusion of AI leveraging their unique data advantage. And that advantage is real. Think about the data flowing from almost 850,000 apartments, 3 million devices.
Right, real-time data on access, maybe temperature, humidity, potentially water sensors. AI is often a buzzword, but how could it actually help SMRT financially here beyond those $30 million cuts?
Well, directly supporting that 70% SaaS margin, think about reducing friction. Internally, maybe AI helps customer service handle inquiries faster, more efficiently.
Okay, internal efficiency, got it.
But externally, too. Proactive diagnostics. Imagine if their AI can analyze patterns and predict a likely water leak in Unit 4B before it happens. That saves the property owner enormous cost and hassle.
So it moves SMRT from just being a convenience provider, letting residents unlock doors, to being a risk mitigation tool and an operational intelligence platform for the landlord.
Exactly. And that's the kind of value that justifies a higher ARPU, like that $8 plus they're getting on new deals. It makes the platform much stickier and more valuable.
Okay, let's pull back for a second. Put this in the context of the broader market. This is happening in the residential real estate tech space, prop tech. That sector's been pretty sensitive to interest rates.
Yeah, the macro backdrop isn't exactly a roaring tailwind. The real estate sector ETF, XLRE, has had pretty modest returns this year. So SMRT is trying to execute this tricky internal pivot against a sort of lukewarm sector background.
So near-term risks are definitely there. Margin pressure probably continues for a bit while that hardware mix shift plays out. Maybe Q3, Q4 still see some of that.
Right, and there's always the risk that pulling back too hard on hardware, even low-margin hardware, could temporarily slow down the overall booking momentum until things normalize. Execution risk is high.
So if you're watching SMRT over the next, say, 6 months, what are the key catalysts or milestones you're looking for?
Number one for me is sequential improvement in that SaaS revenue growth and the overall revenue mix. Need to see clear evidence the pivot is gaining traction quarter by quarter.
Makes sense. What else?
Number two, concrete progress towards that exit 2025 cash flow neutrality target. Are they hitting the $30 million savings milestones? Is the cash burn actually stopping? Getting to neutral would significantly de-risk the story.
And number three?
Keep an eye on any actual product launches or results coming from those AI initiatives. Are they delivering features that genuinely save clients money or provide new insights? That's the long-term value driver. Success really hinges on executing this SaaS shift flawlessly over the next few quarters.
Which brings us nicely to our segment where we brainstorm a potential trade idea. And just the usual, very important reminder, this is purely hypothetical for discussion only. Definitely not financial advice.
Got it. So the pitch here really leans into two things we've talked about,
Right.
that strong liquidity position and the aggressive cost-cutting plan.
The cash floor and the self-help story.
Exactly. You've got $105 million in cash, that $75 million undrawn revolver. You've got a clear path, they claim, to $30 million in annual savings. And the core SaaS business you want to grow has those juicy 70% gross margins.
So the company isn't facing an existential cash crunch while they try this turnaround, and they're actually using some of that cash.
Right. They bought back stock in Q2, about 4.1 million shares for $3.7 million. The stock was trading somewhere around 91 cent pre-market around the call. That's pretty low if you believe they can actually pull off this transition.
So the trade idea is...
It's basically a long thesis, betting on management successfully hitting that cash flow neutrality target by the end of 2025 and coupling that operational success with an accelerated share buyback program, using that strong liquidity to retire shares while the price is depressed.
Okay, I see. So the idea is the cash protects the downside while they fix the operations. If they do fix the operations and get to neutrality, and they've been buying back stock cheap the whole time,
then the reduced share count acts like a lever. When profitability does arrive, hopefully in 2026, the earnings per share get magnified significantly because there are fewer shares outstanding. It becomes a leveraged play on successful execution backstopped by cash.
a bet on Martell and the team pulling off the pivot, essentially. High risk, relies on perfect execution, but the cash cushion makes it, well, plausible.
Plausible is a good word for it. Definitely not a sure thing.
Okay, so wrapping up the deep dive on SMRT's Q2, the core takeaway really seems to be this divergence. A challenging quarter on the surface, driven by a very deliberate, almost surgical strategic shift away from low-margin hardware towards higher-quality recurring SaaS revenue.
Yeah, and that shift is underpinned by aggressive cost cuts aimed at near-term cash flow neutrality and a strong balance sheet providing the necessary runway. Execution is everything now.
So the final thought to leave you with, let's circle back to that AI piece. We talked about the $30 million cost cut program that's mostly blocking and tackling staffing third party.
Right, necessary stuff.
But what if that progressive infusion of AI actually starts delivering significant operational leverage beyond that $30 million target? Think about SMRT using AI to really cut down on things like field service technician visits or automating risk detection like those water leaks across 850,000 units.
If they can crack that code using their data moat to drive real operational efficiency gains at scale.
How much more leverage could that unlock? Could that be the thing that accelerates them from just reaching neutrality in late 2025 to achieving meaningful, sustainable profitability much faster in 2026? Something to think about.
Definitely something to watch. The potential is there, buried in that data.
Indeed. We certainly encourage you to keep tracking SMRT's progress, especially on hitting that cost-saving goal and the neutrality target. We'll be watching too. Thanks for joining us on Talk Tickers.